I want to welcome you to this edition of FCHEA's Circuits webinar series. I'm Frank Wolak, President and CEO of FCHEA. FCHEA initiated the Circuits webinar series to offer timely and relevant topics to industry. The series is designed to offer deeper insight on specific topics than are found in more general webinars. And today we are pleased to offer a discussion on federal tax rules and the impact on hydrogen fuel cells and clean fuel development. For those who don't know about FCHEA, we are the Industry Association for Hydrogen in the United States. We have been advocating for hydrogen and fuel cell technology for over 30 years, representing leading companies and organizations and organizations involved in all elements of production, distribution, and use of hydrogen. And we are very active in advocacy around the country. Today, we are going to be getting into a very important subject. The subject of tax rules is complex and always open to discussion and comment. The Section 45Z rules, or the Clean Fuels Production Credit specifically, are of unique importance as they have implications for sustainable aviation fuel and derivative fuels, but also because hydrogen is an important feedstock and hydrogen projects are valuable to the overall production of those derivative fuels. So there's linkage in the Clean Fuels Production Credit. Today, we are going to dive into a variety of areas related to 45Z, as well as touch on the foreign entity of concern, or FEOC rules, as they may apply to the credit and also projects. For FCHEA members, this webinar will consolidate many topics discussed in our regular Government Affairs Committee meetings and our internal communications. For non-members of FCHEA, we hope this webinar consolidates many topics. We hope this webinar opens insight and areas of importance to your businesses. Anyone interested in FCHEA membership, you can reach us at fchea.org. I'm pleased today to bring together a very strong panel of tax specialists who will each address key areas. We have Barbara DeMarney, a partner at Baker Botts, Don Lonzak, tax partner with Pillsbury, Winthrop, Shaw, and Pittman, and Tim Urban, senior principal at Bracewell LLP. I'm going to turn this now over to Tim, who will begin the discussion, and we will move to the other presenters with their key areas. So Tim, why don't you take it from here and give this audience of over 225 registered attendees a great deal of insight into how these tax rules apply to them. Thank you.
Thanks, Frank. This is Tim Urban with Bracewell. I'm thrilled to be here today with an esteemed panel of tax attorneys. Pulling back the curtain just a little bit, I think you'll discover that there's an ongoing sort of symbiotic relationship between tax lobbyists such as myself, the transactional attorneys who supply all of the deep thinking, and the trade association executives and staff who make all the magic happen. So first slide, Frank, is entitled Legislative Outlook. This slide is for people that eat dessert before the entree. I just wanted to get to sort of the bottom line, which I know would come up in questions anyways, like what's going to happen? Will there be a big reconciliation bill this year? Like all majorities, the current Republican majority in the House and Senate have managed to give lots of head fakes back and forth as to whether there will or will not be a tax reconciliation bill at the end of the year. I'm going to, go way out on a limb and say I don't believe that there will be a big tax bill, a big Republican reconciliation bill. Now, for those of you who are insiders on this call who are already trying to beat me to the punch with the next question, I think the next question will be, so in the absence of a reconciliation bill, is there a chance there could be an end of the year tax extenders bill or a bipartisan bill? And I think the answer is that yes, there's a possibility. I think that possibility is sort of medium to low. And the reason I think that is that right now, as we get closer and closer to the midterm elections, I think members of Congress and senators and administration officials are thinking more and more about the elections. There's a big question as to what will happen, whether Republicans will maintain a hegemony on both the House and the Senate with majorities in both bodies, whether the Democrats will change the dynamics and take control of one or both bodies. So I don't get the sense that there's a lot of thinking on Capitol Hill about a bipartisan bill. I do get the sense that there's a lot of thinking on Capitol Hill about what people will do in early 2027 if they're in charge. So if we could please go to the next slide. Uh, One of the other questions that invariably comes up, we have some seasoned lobbyists among the FCHEA Government Affairs Committee who sharpshoot speakers relentlessly. People ask, well, what about the technical corrections? Because as you may be aware, there's an ever, growing kind of package of fixes that need to be done. And I think that the conventional wisdom is that technical corrections almost always get done, but they very rarely get done promptly. So this is another package that I don't think is probably going to move in 2026. If I could go to the next slide, please. This is kind of getting into more of the meat of our discussion, and I would, invite my fellow panelists to jump in. As you guys know, the IRA in 2022 was sort of the seminal, very significant renewable energy bill, renewable energy tax bill. It changed everything with this whole idea of technology neutrality. And then in 2025, the 4th of July, as a matter of fact, the president signed into law the One Big Beautiful Bill Act, which is referred to at the Treasury Department as OB3. And this was sort of a mixed bag. It was very surprising, I think, for some people, although, Barbara DeMaroni and Don may have been ahead of me. Republicans in the end turned out to not repudiate the idea of these technology neutral bills. They actually attempted to perfect some of them, like, for instance, 45Z. They did terminate or shorten the lifespan of a lot of other energy credits. And so there were some specific items that I know were not, received with joy by some people on this call. For instance, the removal of the 75-cent bonus credit for SAF. It's kind of a big deal, especially to investors. There are limitations on feedstocks for fuels and modifications to treatment of negative emissions rates. If we could go to the next slide, please. So, this slide is really significant because, vast swaths of company people and trade association people have been, kvetching, to use, I think, the Yiddish, about the absence of really good guidance on 45Z. Under the Biden administration, 45Z sort of came last, and the guidance was not as thorough as it maybe could have been. Then under the Trump administration, they have finally turned to publishing a notice of proposed rulemaking, which is a big deal for people like Don Lonzak and Barbara DeMaroni. So this is an ongoing process. You'll see in this slide a bunch of dates. April 6th is a really, really big date. That's the deadline for public comment. So all the company and trade association people will be working and are working, assiduously trying to get their ducks in a row for that. Those comments are really important. The Treasury by law has to respond to comments when they publish a final rule, and they have to justify their behavior. So this is, again, a big deal, and it will be followed, once the comment period is complete, by a public hearing where people like you, Frank, and others get a chance to look the Treasury and IRS tax attorneys in the eye while you recite your wish list at the IRS auditorium. And then finally, we believe that there will be a final rule sometime thereafter. It does take time because, like I said, the attorneys at the IRS and Treasury have to literally go through each comment letter and identify, what the issues are and try to provide a rationale for where they come down. So, this is a period where the transactional tax attorneys, like, for instance, Don and Barbara, are super busy because they're working with each of their clients, going through a very lengthy list of potential issues, trying to prioritize what they're going to say, and trying to build coalitions with other companies and trade associations. So last, I just want to go through this slide number 8, the NPRM publication slide. And this just gives a very, very high level overview of some of the very significant changes that were itemized in the notice of proposed rulemaking. And I think Barbara and Don are going to help take you through those. A couple that just jump out at you. This qualified sales rule applied to most taxpayers. I think it was something that the Biden administration, I think, got wrong, and that was a big topic on Capitol Hill during the legislative consideration of the OB3 bill. And then, in my personal opinion, I think Treasury took the pro-taxpayer approach and got it right. And there's a number of other, technical issues here that I think we're going to go through in upcoming slides. So I think now, Barbara, are you on deck?
Don is.
Don's on
I'm
deck.
sorry.
Actually, we've got Tim to take it from here. Tim, thanks for that intro. You're going to circle back to hear Tim again in a subsequent portion of the session. But Don, why don't you take the floor here?
Very good. So, hi everyone. Don Lonzak, thrilled to be invited to speak to you all today on a topic that is of great interest, I think, given the recency of the issuance of the proposed regulations. So I think right here, we're just going to start with an introduction to 45Z generally, and before turning to issues that are either addressed or still outstanding based upon the proposed regulations. So 45Z, after amendment by the One Big Beautiful Bill Act, is available for production of transportation fuel between the years of 2025 through 2029. Two basic requirements: the production needs to occur in the United States of a qualifying transportation fuel, and there needs to be sales of that fuel in quote unquote qualified sales to unrelated parties. The credit is basically calculated based upon the gallons of transportation fuel that's produced and sold to unrelated parties, the applicable amount of the credit, and then multiplied by the relevant emissions factor for the transportation fuel. The applicable credit amount is basically $1 per gallon, assuming the prevailing wage and apprenticeship requirements are met as set forth in 45Z, and otherwise the credit amount is basically reduced by 80% to 20 cents per gallon. Worth noting that prior to amendment by the most recent tax legislation, the credit for sustainable aviation fuel was actually $1.75, but the One Big Beautiful Bill Act essentially leveled the credit amount and made it $1 both for vehicle fuel and aviation fuel. And the last note on this slide is basically one of the requirements to qualify for the credit is that the emissions rate for the relevant fuel needs to be less than 50 kilograms per CO2 per MMBTU. And if we move to the next slide, we essentially have an illustration of this. So basically, this example shows gallons of transportation fuel multiplied by $1, multiplied by the emissions factor. If you assume an emissions rate of 0, basically you would qualify for the full credit of $1. If instead the emissions rate was 25 kilograms, then you qualify at a 50-cent rate. Prior to amendment by recent tax legislation, if the emissions rate was negative, there was this possibility that the emissions rate could be above $1 per gallon, essentially creating an exponential credit amount for fuels with negative emissions rates. The One Big Beautiful Bill Act did away with that possibility, with the exception of feedstocks derived primarily from animal manure, where Treasury was given the regulatory authority to allow for negative emissions rates. And at least based upon the proposed regulations, it seems that they are inclined to go ahead and do so.
Hey, Don?
Yes.
Hey, this is Tim. I just wanted to add a little color. This change in OB3 to the rate available for SAF was somewhat of a grievous blow because it takes more money and more industrial processing to make SAF generally from feedstock or from transportation fuels. So having the SAF fuel be eligible only for the same amount as a highway fuel is somewhat of a poser to investors. And I just wanted to point out there is already legislation that's been introduced in Congress by bipartisan groups that are looking to restore that 75 cents.
Thanks, Tim. All right, could probably move to the next slide. And just a few additional topics to cover as a general overview. The first being how emissions rates are determined under 45Z. If we go to the next slide. If you can go back one, please. So emissions rates for purposes of 45Z, you're generally looking to life cycle GHG rates, wheel to well as well to wheel as described. Basically for vehicle fuel, the GREET model is the accepted approach for determining emissions rates. And for SAF, generally looking to the FCHEA model or a similar methodology, and noteworthy that the proposed regulations and other guidance published by the IRS essentially acknowledge that the GREET model generally would be an acceptable similar methodology for purposes of SAF fuel. As directed by statute, the IRS is supposed to publish an annual table of emissions rates for various categories of transportation fuels. The first table was released, I think, January of 2025 under notice 2025-11. The industry is anxiously awaiting issuance of an updated table, particularly reflecting various amendments made by the recent tax legislation. Now, if a particular feedstock or methodology is not reflected in the annual table published by the IRS, taxpayers have the option to apply for what's called a provisional emissions rate. And the proposed regulations set forth a fairly detailed process for obtaining that rate, basically starting with applying to the Department of Energy for a determination of emissions and receiving a letter back from Treasury that from DOE that then can be filed as part of a tax return in claiming tax credits under 45Z, and as provided under the proposed regulations, the IRS generally will accept that provisional emissions rate as determinative until an emissions rate for the relevant fuel shows up on the annual table. And then final note on this slide, what is a transportation fuel under 45Z? The general description is that it needs to be suitable for use as a fuel, either in a highway vehicle or an aircraft. And an important acknowledgement in the proposed regulations is that actual use in a highway vehicle aircraft is not required. And they provide the example that use as a marine fuel is perfectly acceptable. And notably, the certifications that can be sought from purchasers of fuel do not require any certification that how the fuel was used. They just basically would be checking a box and that as to what category it falls under in terms of whether it's used in a trade or business or the like. And then from there, I'll turn it over to Barbara.
Yeah, we're going to shift now. We've got the introductions and some of the basic fundamentals of 45Z. If you go to the next slide here, Tobias, we're now going to kind of turn this over to Barbara because as the team came together, they realized that there were some, we call them hot issues that were really more relevant than other points. And we're going to start by having Barbara really unpack these with some detail with our other panelists providing comment as appropriate. So Barbara, why don't you take this now and walk us through these key hot issues?
Sure. Thanks, Frank. This slide that we're looking at has just got a list of things that we've identified as topics that are probably ripe for comment, concerns that we have after looking at the proposed regs. The first one on the next slide is about what's referred to as the primary feedstock issue. The regulations reflect the amendment in OB3 that was designed to prevent doubling up on 45Z. So having more than one taxpayer claim 45Z with respect to one fuel that ends up in one particular tank. And the example is producer A makes hydrogen, which qualifies for 45Z. We'll just assume that. So producer A could have claimed 45Z, wants to claim 45Z, but sells the hydrogen to producer B, who makes the SAF using A's hydrogen as its primary feedstock. So 45Z would have been allowable to A, but under these rules, B cannot claim 45Z for the SAF. And the statute says that you're not allowed to, what the statute does is it excludes fuels produced from a fuel for which a 45Z credit is allowable. The regs have translated that into you can't, it's excluding fuels that are produced with a primary feedstock being a fuel that is a 45Z fuel. So they've taken this produced from a fuel and translated it into looking for a primary feedstock. And that raises a lot of questions as to what is a primary feedstock. When are we going to get knocked out from, being able to claim 45Z at both levels? And one of the specific questions is, can there be more than one primary feedstock? Because if there are multiple primary feedstocks, all of which are eligible for 45Z, that's going to increase the likelihood that both parties aren't going to be able to claim 45Z. So it's really interesting because the regulations are the proposed regulations are kind of contradictory, and you can read into them at different points whether there can be only one primary feedstock, which there are references to a unique primary feedstock in the proposed regulations. But then there's also a sentence where it refers to a primary feedstock and the primary feedstock in the same sentence. So this is something that we've got to clear up, and we've got to help get some more precision around what is a primary feedstock for this purpose. And on the next slide, just some initial thoughts about things that people might ask to resolve this issue. For example, clarification that there can be only one primary feedstock for a particular fuel. And potentially confirmation that if the primary feedstock producer is not producing a fuel that meets the 45Z specs, that it would not be considered to be a primary feedstock. That could cut both ways, though, as we'll see in some of these other issues. So that we're still thinking about that one. And then the other one would be to say that even if the primary producer could claim 45Z, we recognize and acknowledge that we're not allowed to double up on 45Z for the same fuel. So what if the primary producer certifies that it's going to forego the claim for 45Z, and then the secondary producer could claim it. So those are just some thoughts around the issue, and we'll see where this one goes, and we'll see what comments bring up in this regard. The next issue is related to credit stacking. So the issue that I just went through was doubling up on 45Z, taking 45Z twice. Credit stacking raises the issue of taking 45Z and also taking one or more of the other clean energy tax credits for the same production process. And the way this issue arises is that the statute says that you can't claim 45Z for fuels that are produced at a facility that also allows, that is allowed either 45V clean hydrogen credits or 45Q carbon capture credits. And so it all centers on your definition of what is the same facility, because you can't have it at the same facility. Okay, so the next slide gives us a diagram that is just sort of supposed to illustrate the stacking question. And it shows a situation where maybe you are starting with renewable power, like a wind farm or a solar farm, that's powering a hydrogen facility, an electrolyzer that's producing green hydrogen. And that green hydrogen is then being sent to a production facility for, call it what you will, because these things, we refer to SAF. Sometimes people talk about synfuels, e-methane, e-fuels, E2X, but it's some type of clean fuel that's being produced. And then simultaneously, let's say that you're going to mix in at that production facility CO2, and the CO2 is coming from carbon capture, that is carbon that's being separated out of renewable natural gas. So in this green strip across the bottom, in theory, what you would like is the power plant to take a credit for renewable power production. You'd like the carbon capture to take a credit for 45Q. You'd like the hydrogen facility to take the clean hydrogen production tax credit for 45V. And then you'd like the clean fuel producer to take 45Z. So is this considered to be the same facility? And then that's going to be a problem if it is. So on the next slide, we have what the proposed regs tell us about what is the same facility. And they give us, the first three bullets are the rules that they have given us. And one is that they say that a facility includes all the steps of the production process, from the processing of the feedstock. Note that doesn't say production of the feedstock, that says the processing of the feedstock through to the transportation fuel that is sold. That's the basic definition of a facility. It also says the facility does not include the feedstock production equipment. So that's good. That says that our hydrogen production facility is not part of this clean fuel production facility. But then it says that if the facility uses the fact of carbon capture to reduce its emissions rate, when it calculates its life cycle GHG emissions rate, it reduces it for the fact of carbon capture in its production process, then we're going to say that the carbon capture equipment is part of the facility. Okay, and they also go on to say that you can't get around these rules by separating these facilities by a lot of geography, by different owners, et cetera. So there is an important example in the proposed regs, and the example illustrates that it posits a situation where the carbon capture activity is used to bring down the emissions rate. And then it concludes that because the carbon capture brought down the emissions rate, the carbon capture equipment is part of the facility. So that means 45Q is being taken at the same facility as 45V, so you can't have both. Okay, the problem is that we need, that's a negative example. That example says, you do this, you can't get both credits. We need an example that says, if you don't do this, you do get both credits. So what I think we're going to be requesting is something that makes very clear that, that if you are not including a production process in your emissions rate calculation, that you are then allowed to consider it as not being at the same facility. The next hot issue I want to turn to is pro rata attribution to fuel blends. So the proposed regs have in them a rule that says that when producers with different, so producer A makes a gallon of a type of transportation fuel that has a really low emissions rate associated with it, and it would get a really good credit. Producer B makes a gallon of transportation fuel that is doesn't have such a good emissions rate, and the credit would not be so good. They both put 1 gallon into the tank, and then down the road at some point, one of the producers pulls out a gallon, okay? The proposed regs say, in that case, the gallon that you pull out, let's say it's producer A that pulls out a gallon because it put in 1 gallon. They say we're gonna prorate, and half of that 1 gallon that you pull out is going to have a good emissions rate, and half of it is not. And so this is alarming to producers that think that they've got a really good rate, and then they, just because they happen to put it in a tank with, it gets mixed in with others, you know, that they're penalized for it. So there's a fairness issue here. And there's also an administrability issue, because I gave you the simplest possible example, but imagine that multiplied by millions of gallons and, you know, scores of different producers. So there will definitely be comments on this. And I think Tim has already been talking to people about this, this issue.
Barbara, you're exactly right. I think you're going to see some of the biggest energy taxpayers in the country weighing in heavily on this, because I think it could cause real chaos, and I don't think it was intended.
Okay, and so on the next slide, the issue is hydrogen purity standards, and that one is that in order for it to be qualified fuel under 45Z, it has to be a transportation fuel. And with respect to hydrogen in particular, the proposed regs define hydrogen that is eligible for the credit as a gas or liquid that meets a specific specification level that's published by the Society of Automotive Engineers. There are other possible standards that could be used, and it's our understanding that in the hydrogen industry, the Society of Automotive Engineers standard is not necessarily the one that the industry is actually following, and it may be a higher hurdle than we want. So there is clearly room for discussion there. And Tim, I think you had some thoughts about that one as well.
Thanks, Barbara. All I wanted to add is that this issue, I'm very hopeful that FCHEA will be able to get this turned around, because there are literally probably a dozen of these sort of foot fault technical specification issues, whether they're ASTM specs or SAE specs, et cetera. And they trace their origin story back to the IRA, when, you had congressional staffers, congressmen and senators who were sort of throwing these specifications around without really a lot of in-depth professional experience with all the nuances of what they mean. It turns out there are a bunch of specs for hydrogen, depending on what the application is. And I think that they inadvertently put their finger on a spec that is a pretty narrow one that is not necessarily required, and it's not one that many of the industrial gas companies make the hydrogen to satisfy as a general matter.
Okay, so I've done a few of these issues, and I think Don is going to take the last two. That if we could go to the next slide.
Yeah, Don's going to take it over from here. We're going to get into a bit more about emissions credits, RECs, and qualified sales issues. So Don, you got the next couple of segments here.
Thank you. So yeah, on this slide, we're looking at the possibility acknowledged by the proposed regulations for the use of RECs or other so-called energy attribute certificates as a way to reduce emissions rates relating to the production inputs for transportation fuel. The regulation, in effect, just essentially adopts principles similar to those found in the regulations issued under 45V for clean hydrogen production. So essentially, the three-pillar requirements that are tied to the use of energy attribute certificates. Notably, under the 45V rules, the facility to which the energy attribute certificate is attributed must be relatively new, must have a commercial operation date no more than 3 years before the relevant production facility is placed in service. And of course, when we move to clean fuel, we have facilities that have been placed in service for a long time. So there was a significant debate as to what that meant in terms of how far back you could look for facilities from which you can obtain energy attribute certificates. The proposed regs set forth a specific rule in this regard that essentially deems a taxpayer's facility to be placed in service on the first day of the first taxable year in which it produces transportation fuel. And sets forth an example of a facility that is upgraded to produce qualifying transportation fuel on January 1st of 2024.
21.
Go ahead.
21, right? 2021?
But the transportation fuel facility was upgraded on January 1st, 2024, 1 year before the credit went into effect. And then you look back 3 years from 2024, and the electricity producing facility can have a commercial operation date of January 1st, 2021, and qualify for issuing energy attribute certificates with respect to that facility. Again, even though the clean fuel production credit wasn't even in effect for the 2024 year. And we can go to the next slide. And this, I think, may be the most significant issue that was resolved by the proposed regs that was a problem for the industry. Of course, a key requirement under 45Z is that there need to be qualified sales of the transportation fuel to unrelated parties. In draft regulations that were issued, I think, January 2025, Treasury and the IRS had slipped into the 45Z requirements that fuel for use in a trade or business needed to be used as a fuel in the relevant trade or business. And that called into question what happened what happens if fuel is sold to a marketer or other middleman for resale to other parties that would use the transportation fuel in a business. The proposed regs made a significant fix in this regard. First, they removed the as a fuel addition to the use in a trade or business requirement, and they expressly provided that sales to middlemen are qualifying as long as the middlemen subsequently sell the fuel to an unrelated person. And just a final point here, the original version of 45Z provided a very limited related party exception, essentially relating to sales within a consolidated group of corporations. The One Big Beautiful Bill Act granted Treasury the authority to expand the related party exception to broader concepts. And under the proposed regs, Treasury has taken advantage of that opportunity and essentially now has a related party rule that applies a common control test, essentially greater than 50% ownership among various parties will be considered a qualifying sale, again, assuming that the related party on sells to a unrelated person and as part of its trade or business. And Barbara, I think back to you for FCHEA discussion.
Right. Thank you. So now we're going to switch gears, and we just talked about new developments with 45Z. Now what we want to talk about is a set of rules that applies across a number of the different clean energy credits that were enacted in OB3, and they are designed to get at involvement or benefit of interests from China, Russia, North Korea, or Iran, four countries, four covered nations, as they're referred to. And so entities in those countries are referred to as foreign entities of concern. And so that's why this set of rules is referred to as the FCHEA rules. And this set of rules is very extensive, very complicated, and sets out a web of restrictions on the ability to claim most of the clean energy tax credits. So I want to give you a very sort of high-level sense in just a few minutes that we have of what these rules do, what they're about, and then finish up by describing or providing you with some implications of these rules for the hydrogen industry in particular. So what do these rules do in terms of restricting ownership? They restrict who can claim the credits. So for most of the clean energy tax credits, you can't even make a claim for the credit if you're considered to be what's referred to as a prohibited foreign entity. So that knocks you out from claiming the credit. There's also trading in tax credits today, and these rules prohibit someone from being a buyer of a tax credit if they're a prohibited foreign entity. And then there's a set of rules that apply at the project level. It doesn't apply to who can claim the credit. It applies to whether or not your project is eligible for the credit because, for example, it has an excessive percentage of components that come from covered nations. And then there are also some recapture rules and new penalties. So on the next slide, And I want to tell you that this slide, if you don't save anything else from this presentation, I think that this slide is probably the one that is the most useful slide in the entire deck, because in one picture, it's sort of telling you how to think about and how to figure out, just broad brush, what these rules do and whether you're going to be caught by them. So as I said, the problem is that there are restrictions on prohibited foreign entities. So your first question is going to be, am I a prohibited foreign entity? Okay, I'm a US corporation. How could I be a prohibited foreign entity? Okay, prohibited foreign entity doesn't have a definition of prohibited foreign entity. It just says prohibited foreign entity is defined as either a specified foreign entity or a foreign influenced entity. So then you just go down to the next level and you say, okay, well, am I a specified foreign entity? All right, how is a specified foreign entity defined? It could be one of two things. There's a specific list of bad entities, and it's entities that are listed by name that are deemed to be sort of foreign terrorist organizations or bad actors. So you go down that list and you say, I'm not any of those. Am I a foreign controlled entity? So this definition, which, as I said, gets to be quite complex, is basically going at an entity that has more than 50% foreign control, equity control. So you're looking for 50% ownership by, for example, Chinese nationals. And that really focuses on equity. So let's say I've gone through that definition in detail and I'm comfortable, I'm not a specified foreign entity. I still have to figure out, I have to go back up and go over to, am I a foreign influenced entity? And this is where it gets really tricky, because foreign controlled entity, we're looking for 50% equity. Foreign influenced entity is going to bring in a lot more sort of grayer test, not quite as bright line. It could be 25% equity ownership. It could be 15% of the debt. And then worst, it could be the mere fact of agreements that your entity, your US entity, has entered into with foreign controlled entities. And those agreements could be, for example, license agreements. So if you're a US company that's building a project, and you're getting all your technology from China for the project, you could be pulled in under this foreign influenced entity test. But that is just broad brush how these rules work and how you figure out if you're a prohibited foreign entity. So on the next slide, as I said, I'm in the hydrogen business. Do I have to worry about these FCHEA rules? Does it really hit hydrogen? Well, the amazing and fascinating thing is that 45V, the basic production tax credit for the production of clean hydrogen, has escaped. You could be a Chinese entity and you could producing clean hydrogen in the US, and you would not be knocked out by the FCHEA rules, because the FCHEA rules were not loaded into 45V like they were loaded into the other provisions. So that's, and we don't know why. Some people have surmised that it was just forgotten. It was just like an inadvertent oversight. But whatever the reason, we're very happy that that was the result. So other credits that could impact a hydrogen business are the two investment tax credits that are under 48E. One is for hydrogen storage facilities. You can get an investment tax credit for building hydrogen storage, hydrogen tanks, et cetera. But you cannot claim that 48E credit if you're a prohibited foreign entity, because those rules are loaded into 48E. And also that second level I was talking about, the material assistance, the excessive percentage of foreign components, those rules apply to the building of a hydrogen storage facility and claiming the ITC. And for fuel cells, which get a 30% ITC, the same situation applies, that you're going to have to figure out whether you can claim the credit, that you're not a prohibited foreign entity, and also figure out whether these material assistance rules looking at the components apply. And then finally, for clean fuel production, the same restriction on claiming for prohibited foreign entities, but luckily we don't have to look at the components of the project, the facility that was built to make the transportation fuel. It's just the claiming of the credits that's subject to these rules. So that's a whirlwind tour through the FEOC rules as concisely as I can give it. But I think at this point, maybe with the little time we have left, we can talk about any particular questions that have come in or questions for the panel.
Well, Barb, let me take this and kind of segue over to the question period. There may be one question I think that is really important to address. As I mentioned in my opening, the subject of tax rules is important, complex, and obviously open to comment. We've walked through legislative developments, 45Z basics, hot issues, qualified factors, and it's pretty clear that applicability is not always obvious. And one of those factors that helps clarify applicability is, in fact, filing comments. We're in a comment period that opened up with this notice of proposed rulemaking on February 3rd. Those comments are due on April 6th. I want to maybe turn this over to Tim for a starting point, and then the others weigh in. Can you discuss the process of the comment filing, what's important, and perhaps the distinction between comments filed by individual entities versus associations and groups? That may get the ball rolling here. So, Tim?
Well, thanks, Frank. I like to joke that the comment production and filing is a team sport. Just keep in mind, I think, just as a level set, that many, if not most, of the comments that are filed on these voluminous tax regulations end up not being successfully addressed, right? So, you've got, in the case of 45Z, literally thousands and thousands of comments that come in. Many of them are like written on the back of a napkin kind of thing in crayon and are sort of discarded because they don't meet the minimum sort of technical threshold of being credible or legible. Then you get people that are sort of well-intentioned that, make a run at, doing it in sort of layperson speak. And again, those tend to be less competitive. People that are successful in trying to get their way, influence how an issue ends up in the final regulation, generally do like this. You've got the tax director of the company, you've got business development executives, you've usually got outside counsel like Don and Barbara all working together to try to illuminate the key issues, and also I think to perform triage to pick the most important ones, or the ones where the outside counsel may have reason to think that you're within striking distance of success. You don't want to invest all your time and effort on an issue which is sort of dead on arrival. And then once you've got, sort of the sense of your comments for the company done, that's just the beginning. Because, even very influential companies tend not to generally be successful if they're sort of like, the man out in the desert, screaming at the stars. You need to be part of a group. And if you can bring a group of fellow, other companies or a trade association to see it your way. If your trade association, one thing that I think FCHEA has been very adept at is building peer-to-peer relationships with other trades, to the point where, when Connor gets something, a hot issue, he can call out to, one of the big business trades or one of the other renewable energy trades and see if they will co-sign a letter or whether he can kind of market the FCHEA comments and have some other trade pick them up in their comments. Because it's definitely, it vastly increases the odds of getting the attention of the administration and the tax lawyers if it's not just a company, but it's a trade, or even if it's maybe an ad hoc group of trades saying the same thing. That in my experience tends to be very successful.
Thank you, Tim. Any other observations about the comment process by either Barbara or Don? Anything else you want to add there?
I could just comment that from time to time, we as a law firm have submitted comments and we explain that on behalf of certain unnamed clients, we have become aware that there is an issue. And then we go through a legal analysis and submit those comments to tee up the issue and clarify the issue as best we can. Like Tim said, the comments of industry and trade associations are what Treasury and the IRS really want. That's what they want to see. That's what they want to know. So comments from a law firm on a law firm letterhead, although interesting and maybe provides citations or legal support, it just doesn't count as much as the comments that come from directly from companies and trade associations.
Yeah.
From taxpayers, let's say.
Well, good. We have like 3 minutes left here. There's a few questions from the audience. One maybe is a little bit of a recap question that I'll cycle back here. Maybe Barbara, you can kind of summarize briefly, how do the 45Z and 45 rules sort of interplay? Just to kind of a recap of some of the detail that was given earlier, top level.
Well, 45Z is a production tax credit for transportation fuel. And so it is available over the years that the credit is in effect right now through 2029. But there are other clean energy credits that like one's for carbon capture, one for the production of hydrogen, that could have a role to play in a hydrogen business. And the restrictions that we have the problem with trying to stack multiple credits always comes back to are you considered to be part of the same facility? And so that's why we sort of went through that discussion about everybody wants to get as many credits as they can possibly get for a particular production process. And the question is, how can we do that? So.
Well, I appreciate that. We are just about at the top of the hour here, and I want to thank our panelists for their insight, the details that they provided, and for the opportunity to kind of present all this to both our members as well as a broader audience. Please look forward to future editions of Circuits. Keep a lookout on our LinkedIn site and our website as we look to define new topics that you all will find interesting. And with that, I'd like to thank everyone and close this session. And I wish you all a good afternoon. Thank you.